The current economic landscape is filled with challenges and uncertainties ranging from government surveillance and privacy concerns to loose monetary policy, financial crisis, and the need for rate hikes to combat this raging inflation that we've been seeing. The Federal Reserve's role in these challenges has been both praised and criticized, depending on who you ask. And on the one hand, you've got the Fed, they're trying to stabilize the economy during these crises. On the other hand, they've got this loose monetary policy, which led to excessive risk taking, financial fragility, and concerns about potential future downturns that, by the way, we're heading in now. The stock market faces increased volatility. It's adjusting to the changing monetary policy that is tightening monetary policy. And the decline in container imports, you look at the freight, you look at what's happening with the imports and exports right now, it is a very clear sign of weakening demand and economic growth, which is sparking fears of an impending recession. And of course, we're talking about official recession here, not you and I, what we know. Well, there's a new budget that's going through, $6.9 trillion. That will be the largest in US history, also raising concerns about the potential impact on the national debt. This is going to be paid for. They tell you it's going to be paid for, but you and I both know inflation is going to be the result of it. Some economists argue that a more hands-off approach to monetary policy could help prevent future crises. Others are saying, no, we need bailouts. We need them to take action. Well, if you look at what's happening with the wars that are expanding, with the money that's being printed, and yet you as the individual are getting less and less out of this as a result. A lot is happening here. I want to break it all down for you today, beginning with this. Looking at the executive order on ensuring responsible development of digital assets. And this comes, by the way, directly from the White House website. They are talking now about cbdc's. And it's very important that we bring this front and center. It's a digital form of a country's sovereign currency. They want this. They do, in fact, want to have a digital currency so that they can track and monitor everybody's access to everything. Don't think of it as being, some fancy thing. It's not. Neil Kashkari, Fed President Neil Kashkari, said, there's no advantage to a central bank digital currency. We could do everything that it can do. It's not, don't think of it like, oh, it's on the blockchain, it's some sort of crypto. None of that at all. And there's a lot of people talking about XRP, Ripple. Oh, this is going to link with this and that. This is not what it is. The purpose of this is to track and trace every single transaction and to cut you off when the time is right. If you don't believe it, look at what they've done many times before. Your access to your own money will be limited, and they can do this on many different levels. I talked about it just a few days ago, and I will bring you more information about that. If you are interested, please subscribe to the channel and check back daily for updates. You look at what we've seen with the Federal Reserve, and in my opinion, it is wild. I've studied the history. I've studied a lot of monetary history, and it is, in fact, absurd. The amount of money that they printed and the actions that they've taken have, quite frankly, been a little bit aggressive, and this comes directly from the Federal Reserve. Okay, this is a quote that they're pulling from, and they did their report, in this case here, and it shows us that a study by the US Fed found that loose monetary policy can lead to disastrous consequences, including financial crisis and high inflation. The study argues that the cost of loose monetary policy may not be immediately apparent, but can accumulate over time and lead to negative outcomes. They also suggest policymakers should be careful and weigh the benefit and costs of monetary policy decisions. That sounds a lot like the money GPS. I mean, that's literally the money GPS. But it's also the Federal Reserve. And so these reports come out and they put them out, and nobody's obviously going to give them any attention, but you get them from me because that is the truth. If you print money today, it doesn't take effect tomorrow. It might be 2 years, it might be 5 years, it might be 10 years. But the effects we feel today are probably more likely not from 2020, but from 2008. And of course, everything before that. But you see, this is the Federal Reserve talking. When I give you data, when I give you information, understand that it comes from so many different sources, including what I would consider the enemy itself. We have this. Stocks hammered as Powell testimony points to a 50 basis point March rate hike to combat sticky inflation. This comes, of course, from later on in last week. And you got to realize what's happening here is that you look at the jobs numbers, you look at everything that's been coming out. It's looked supposedly strong. Oh yeah, everything's great. But inflation is the one that they're watching. And this comes in many forms. Employment is one specifically that they do love to look at. And if it's super strong, why wouldn't they increase more? Well, you see what's happening with SVB. A bank collapses, that's kind of a big deal. So the expectation here is that they're going to go away from that. They're going to let inflation run real hot, and they're going to go and actually change it up and print money, perhaps bail them out. At the time of this recording, that hasn't happened yet, but we'll see. It's very worrisome, their actions that I believe that they are ready to take. Fed rate hikes. Where will the S&P 500 and the NASDAQ go now? Well, some are saying that as long as they keep the tightness in place, well, then you're going to have a big issue because it's going to affect, as they say in this article, it's going to affect corporate earnings. And it already has, really. Look at what this one example of SVB has shown us what happens when you increase rates. I think it's very clear. They want the Federal Reserve to change their monetary policy and go into this nonsense of cutting interest rates again, if you can believe it. It's wild. It really is wild. I don't know how else to tell you that. Odds are rising that the Fed will trigger the next bust. And they do talk about this, and you've probably heard this before, unintended consequences. They're creating a moral hazard. But I believe that they're actually going to start cutting interest rates at some point in the near future. Anybody out there who has been talking about deflation, while we could experience deflation, and I do believe there is a natural deflation, this pull-down effect that is happening, but it's being offset by all the money printing, $6.9 trillion. They want to do that. Don't worry, it's going to be paid for. Who? By the taxpayer. The taxpayer will pay. They say that the richest people will pay for it, but it's really just the middle class. And that's the way it works. That's really how it happens. If you look at the data, that's actually what it shows. I think it's important to look at that report directly from the Fed, okay? Because they don't hide it. They really don't. The Federal Reserve has published a paper warning of the dangers of the central bank's indulgence in financial markets. They're not hiding this information. Sure, the majority of people are not going to ever see this report, but you're here, so thank you. And they're not going to show it on CNBC. So this is the type of stuff that we need to realize, and then we make adjustments accordingly. I really do believe, I'll say it again, that they're going to flip on the switch and they're going to pump that cash in. Maybe they're going to wait for a few banks to fail. Maybe they're going to wait for some problems to happen. But here it is. The paper warned that such actions that they've been taking so far could lead to increased financial fragility, including a taper tantrum scenario where investors suddenly react negatively to central bank policy shifts. Very concerning. And this is actually the Federal Reserve themselves. This is just showing us what's happening with container imports. If the US isn't importing as much stuff, what does that tell you about the economy? It's not there. The strength isn't there. So of course that's an issue. Absolutely. It's giving you just that difference in between fourth quarter last year or sorry, all year, and then moving into this year, 2022 versus 2023. So we're moving down. Not extreme, but it just shows us that the growth isn't there. And then we have the prices. Shipping a container, if anybody goes out there shipping a container, if you've ever had to do this, you know the prices. And this is them. They've all come down. Great news. That is positive. I can tell you right now, the prices have declined. Employee prices, whether that's in China or any other country in the US, all of these things have gone up. And so that you experience those there. Warehouse prices have gone up. Every price you can imagine has gone up. Transporting within the United States itself has gone up. All of these things are rising. And so that does have an inflationary impact. The prices that you pay at the store will be higher. That's a simple matter of fact. Okay, so it's just showing us the weakening of the economy as a result, because the demand, it just isn't there. That's what I'm trying to show you. And then we have this, which is essentially saying that the budget proposes the tax hikes on wealthy to reduce the deficit and shore up Medicare. The expectation is you're going to spend $6.8 trillion, but not really, because what they're going to do is they're going to make the rich people pay. That sounds fine and dandy in a sense, but do you believe that? Really? I'm not kidding. Like I really want to know if you believe that. Please put it in the comments below. I will read your comments. I read all the comments. The proposal includes tax increases on high-income earners and corporations to help fund the spending. Critics have raised concerns about the size of the proposal and the potential impact on the national debt. It's going to be too high. It's already too high. And so it's only going to get worse. That's just the way that, in my opinion, I see it. A wartime economy is one that we are in, despite the fact they say, hey, it's peacetime. Well, I don't see that. There's wars everywhere. And the point is they're going to spend way too much. They already have. They're sending billions and billions all over the world. They're saying, hey, this is for you. This is to protect you. This is your national interest. It's our national interest. We're just going to keep pumping out that cash. I could imagine including the black budgets, what they are, but we're talking about trillions of dollars every single year going to death, going to war, going to programs to spy on you. If you like that, I don't agree with it personally. This is just just trying to show a comparison between what we've seen up until this point when it relates to the Federal Reserve and what they've been doing. And, the whole point of this was when you increase interest rates, you slow down the economy. That's it. That's all I'm trying to show you. And what are they trying to do to, help out the economy? Oh, I got an idea. We're going to spend it on war. I got an idea. We're going to, fix infrastructure over there. We're going to send money over here. We're going to do things that make absolutely no sense for you and I. The governments do not help you and I. Like, we have to be clear about that. And when we actually look, like I've read way too much documentation, in my years, and still continue to. If you just took the time to realize it and you read about it, don't just read articles that are written about it, but actually read the documentation. That's why whenever I find an actual document from the source, I give that to you, all the links in the description under the sources, so that we can realize, my goodness, I don't think these people have our best interests in heart. I really don't. And we see that. And so what is the next step? Where are we at? What is the takeaway? I believe we're going through a crisis right now, whether that's coming from the failure of certain banks, whether that's because of a war. Either way, we're going to go in a very difficult circumstance. And I think that we are going to experience major inflation as a result. I think the Federal Reserve is ready for this. I think the government is ready for this. And it's simply a matter of time. Your currency will be devalued. As a result, you want to hold on to real assets during these periods. You want to have diversification of your assets as well. Geographical diversification is important. We do not know what will happen to our currencies and the state of the world. So it is important at this time to take advantage of it while we still can, to have our preparations in place. Search the pillars of prosperity, the money GPS. the pillars of prosperity, the money GPS, and you'll get a full explanation of what I'm talking about. If you appreciated this video, you've got to subscribe to the channel each and every day. I bring you the latest and greatest. See you tomorrow.